Now, the first tick is in the green, so 40 points higher on the Nifty. The mid-cap side of things, which too are not looking so good.
Almost slow burn. The swings are coming, I mean, especially on the Nifty and the big indices. But generally speaking, not very much. It's been lethargic price action, no doubt. The market just is drifting sideways to close flattish. 16,960 is where we are going to close around.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonal Bhutra, and here's the lineup of what we have in store for you. It's a packed show today. In Market Opinion, we have Sanjeev Prasad of Kotak Institutional Equities and Mark Matthews of Bank Julius Baer & Co. All this and more, but before that, we head straight to the day's market action today. And the Lal Street traded in range ahead of an expiry day tomorrow. Nifty and Sensex ended the day mildly lower. However, Nifty managed to hold on to 16,900. BSE firms erased a market capitalization of 1.5 lakh crore rupees today. Adani Group stocks and auto stocks led the fall, while financials lent some support. Prashant Nair is here, as always, with the details. Prashant.
Well, absolutely a flat close and pretty much a repeat in some ways like yesterday, except the fact that yesterday, that is Monday, we had some semblance of a rally mid-afternoon which fizzled out towards close in a sharp way. Today, we did not have that. It was very slow price action through the course of the day, and we kind of closed gently in the red by about 20-25 points. Banks, though, did well. Bank Nifty was up about 0.4%. Thank you to one or two specific names, which I will get to in just a bit from now. But between the Nifty and the Bank Nifty, some slight divergence. We've seen that on occasion in the past as well, and it hasn't really led us to kind of, those trends continuing in any sustainable way. On the stocks front, the Adani Group stocks, and I've said that this is an important constituent for retail/HNI sentiment, they all took a knock, sharp knocks. Ports, enterprises, Total Gas, Adani Green, Adani Wilmar, they were all in the red. Outside of this pack on the Nifty, names like Tech Mahindra, Tata Motors, Hero, ONGC and Bharti were losers. IndusInd Bank was a standout gainer. There was a brokerage report to which it reacted. UPL and Power Grid were the other two notable gainers on the index. In the broader market, I mean, advances outnumbered declines for exactly about 15 minutes after 9:15 when we opened this morning. The lines crisscrossed and we ended deeply negative, almost 3:1 in favor of declines today. Losses coming in names like Kalyan Jewellers, Divijay Diagnostic, Raymond Shipping Corporation, Minda Corp. They were gainers as well, and only a few volume-led gainers for you. PNC Infra, Spark, Imami, Bank of India, Torrent Power, PNB Housing, the pipe maker ISMT, and a few others as well. Globally, things are looking a little better as we start this new week. The pace of activity has slowed down. At least it feels a little lethargic, especially given how manic and frenetic the pace of market activity was all of last 2 weeks. The fear, though, at the margin is that the Nifty perhaps is slowly drifting lower and eventually we'll see a retest of that 16,800, 16,850 levels. The question is, if it comes to pass, will the market once again respect that for the third time and bounce off those levels in a meaningful way? Back to you.
Prashant, thank you so much for joining us with that analysis. In Market Opinion now, Sanjeev Prasad of Kotak Institutional Equity says that there is a risk of further downgrade in earnings. Meanwhile, Sunil Tirumalai of UBS says India is the weakest market year till date among other emerging markets. Take a look.
We still have risk of earnings downgrades going forward, particularly in the discretionary space, given the fact that the slowdown is for real. And from whatever we are picking up, it looks like it will extend for another 2 to 4 quarters. So, yes, you have some downward risk also to earnings. And then you have all sorts of, potential negative news in India in terms of, possibly not so great monsoon this time around. The only sector where valuations are very attractive, I would say, the financial sector. But there, the challenge still remains. You have a lot of global uncertainty. So until that clears, people will still continue to, have a negative view on Indian banks. So having said that, Indian banks have got nothing to do with whatever problems we are seeing in the US. They fundamentally are in very, very strong shape. They don't have the, the asset liability issues which many of the regional US banks are facing. But till that overhang, goes away, I suspect, Indian banks will also struggle despite, somewhat deep value for many of the banks. I mean, most of the PSU banks are now down to, again, 0.7, 0.8 times, one forward price to book.
India has underperformed. So YTD, it's actually one of the weakest equities markets in emerging markets universe. I think, firstly, the earnings growth trajectory in India is normal. It's nothing super exciting. Its numbers from India are not super exciting compared to its own history, whereas for other markets, they are a lot more exciting and they are cheaper compared to their own history, and they are still expensive compared to our own history. Having said that, we are also still continuing to see earnings cuts, in India. I mean, if you actually look at it for 2020, FY24, I mean, I ignore FY23. We are in the year right now. I mean, you always see big cuts in the year in which you're currently in. Even FY24, we are seeing big cuts. We are getting nearly 35 of the 50 nifty stocks are seeing earnings cuts over the last 3 months.
Okay, moving on to opinion from global market experts now. Meanwhile, Mark Matthews of Julius Baer says that a weak dollar will boost Asian markets. Listen into what he had to make of this one.
I think the dollar will continue to slowly decline, barring an enormous banking crisis. And then, I think it would probably be going up as a risk-off kind of thing. But that's not our base case. And of course, when the dollar falls, that's a great tailwind for the Asian markets, including India. I'm not at all disconcerted by India's underperformance so far this year, despite the fact everybody seems to be talking about it. You have to remember last year, in relative terms, it did well compared to most other markets in the world. And the year before, it did very well. So it won't always be outperforming. And this could be a year where it underperforms some other markets. But I haven't changed my opinion at all. We like banks, and I think the Indian market is fine.
Moving on to the third headline today, IRDAI, or the insurance regulator, has announced new regulations that removal of segmental limits and commissions for life, general and health insurers. Under the new norms, the total commission paid by all insurers will have to be under the expense of management limits. PB Fintech hit a 9-month high on the news. Yash Jain is here with all those details. Yash?
Well, important move and a big positive for all insurance companies in life, general as well as standalone health insurance sector, and particularly important for web aggregators like Policy Bazaar. The government, along with the insurance regulatory body IRDAI, has cleared commission regulations for insurance companies. Now, in particular, under these commission regulations, the insurance regulatory body has decided to remove the segmental limits on the commissions paid by insurance companies for the sale and distribution of their policies. Now, to understand this better, there are two things. One is expenses of management, which is a sum total of commission and other operating expenses other than commission. And the second one is, of course, commission. What the insurance regulator has said is that we'll remove the segmental limits, like the commission limits in individual motor, health, accident segment, and we'll put a headline limit in terms of expenses of management. The number is not clear as to what would be the expenses of management limit, but the regulators made it clear that the commission limit has to remain under the expenses of management limit. Now it's up to the insurance company to decide how much they want to spend towards commission and how much they want to keep towards other operating expenses other than commission. This is positive for them because they'll be able to plan their commission structures better, focus on individual segments and spend more, given some individual segments look more attractive to you. For web aggregators like Policy Bazaar, it will be positive because they will eventually get higher commissions when the spending is higher in some segments. Now, of course, this is effective 1st April, but important clarity is still awaited in terms of what will be the absolute number of limit as far as expenses of management limit is concerned.
Okay, all right. And Yash, thank you so much for joining us with all those details. Meanwhile, tax revisions in various investment tools like debt and equity have spurred the interest for alternatives. Rahul Jain of Nuvama Wealth and Nishant Agrawal of ASK Private Wealth say that funds are now flowing into insurance policies. Listen into what they had to say.
People are using this opportunity to increase the allocation on debt and go into debt mutual funds. Apart from that, I think the whole insurance change which has also happened in the finance bill, where the guaranteed plans earlier used to have no ticket size limit, now it is 5 lakh. A lot of money is going there as well, because that provides you still tax-free returns, and also you can lock in your future investments also on tax-free returns point of view.
Tax benefit of insurance beyond 5 lakhs of premium will not be available from policies taken from next year onwards. So these are little more longer term decisions. So investors who were on the fence, probably looking at deciding on insurance in the next couple of months, might be better off by deciding it now for large ticket sizes beyond 5 lakhs.
Okay, that's some expert opinion coming in. With that, it's time for a break now, but stay tuned. We'll be back in a jiffy with the other headlines. Welcome back. You're still with us on Market Today. Let's go to the rest of the headlines that we are tracking for you. To the fourth headline now. Aditya Birla Capital exits the insurance broking business by selling its controlling stake in Aditya Birla Insurance Brokers. Abhishek Kothari standing by with the details.
Well, Aditya Birla Capital is looking to sell stake in Aditya Birla Insurance Brokers to Samara Capital for an enterprise value of rupees 455 crore. Now, AB Capital holds about 50% stake in the company, and the company says that, they will receive further consideration post the completion of 5 years from the deal closing. We have Morgan Stanley, who has written on this transaction. They have an equal rating on AB Capital with a target price of 163 per share. They say that the broking arm sale is being done at a 60% discount to their own current valuation that they have for the broking arm, and the entire subsidiary is being sold for 455 crore, which is a valuation of 5x September FY24 profits. So broking arm contributes about 2.4 per share, that is about 1.4% of the total, to the target price of rupees 163 per share. Back to you.
But Abhishek, stay with us. There's some news on Paytm as well. Users of Paytm wallets can now use their balance to make any UPI payments without using their bank accounts. This comes after the National Payments Corporation of India has announced new wallet interoperability guidelines. Tell us more about this.
Marginal uptick, for Paytm payment wallets. So now the wallet customers can make payments on every UPI QR codes and online merchants. So if you have a Paytm, bank account with you, you can make payments on the UPI or the QR code of PhonePe or any other, QR code that's available. That's what analysts have given me a feedback. Paytm Payments Bank will also earn additional interchange revenue from merchants acquired by other payment service providers, payment gateways, as well as payment aggregators. So just to put the cost in perspective, a bank will earn, that is Paytm Payment Bank will earn 1.1% interchange revenue. This is the revenue that they get largely from Paytm, that is 197 Communications Limited. 15 basis point for charges for adding more than 2,000 rupees to UPI, and 15 basis point when any other wallet is used, to add 2,000 in Paytm Payment Bank. So just to alert our viewers, NPCI announced wallet interoperability guidelines on March 24, 2023. Morgan Stanley has written a note on Paytm. They say their recommendation is of an equal weight with a target price of 695 per share. They say that for Paytm's Payments Bank, the new guidelines could lead to additional revenues. The new guidelines could lead to some higher wallet loading charges as well. So Paytm should benefit as interchange fees paid to Paytm banks actually moves lower. We don't know the context as to how much lower, but it's a marginal decline which should benefit Paytm. Back to you.
Okay, let's talk about the banking space now. IndusInd Bank was up 2% in trade after brokerage firm Bank of America said it sees 50% potential upside in the stock from current levels. Nimesh Shah is here with the details of that report. Nimesh.
There is no big upgrade or a downgrade on the stock, but BofA sees a 50% potential upside on IndusInd Bank, and it's a preferred pick for them in the mid-cap financial space. Now, BofA says that IndusInd is no longer a so-called potential turnaround story. In fact, hard part of the work is already done, and the results will be quite visible and apparent as soon as the next quarter. In fact, at the current levels, the bar for execution is quite low, and that offers a huge margin of safety. Now, there are a couple of triggers which BofA is looking at as far as IndusInd Bank is concerned. The first being the macro and rate cycle is now finally aligned to banks' business mix, so that's going to benefit in terms of earnings. Two, the liability plus the asset quality buffer has improved compared to the peers. And three, the core profitability is still best in class despite the de-risking. So at current valuations of just 1.2 times price to book, the stock is pricing in just 13% growth, whereas even in stress case, the bank is expected to grow at 15%. So there is tailwind for the stock. The valuations are compelling, and BofA sees a 50% potential upside in IndusInd Bank, and that's why it's the preferred pick within the financials for BofA Securities.
Nimesh, thank you so much for joining us with the details of that report. Moving on to the fifth headline now. Crude oil rallied overnight following a boost in sentiment after the Federal Deposit Insurance Corporation announced the rescue of SVB Financial. Supply concerns also forced prices higher after disruption from Turkey and proposed output cuts by Russia. Stronger Chinese demand and a weaker dollar has only strengthened the rally overnight. And with that, it's a wrap on this edition of Market Today. Thank you so much for watching.